In this video, we're going to talk about real estate prices, housing prices. This is one of the hot button subjects that's going on right now. People wanting to know what's going to happen with real estate. Is it a bubble? Will prices go down? Are you going to get stuck with a property if you buy something? Is your house overpriced that you own right now and you want to sell it? Is now a good time to sell? The best way to look at it is a comparison with historical models, but also with the reasons for historical models. On the screen, you'll see a chart of pricing for homes over the last, really, 60 years. It goes back to 1965, and you can see the chart goes up and slides up until you get to 2007, and it was a peak. And then it went down. We all know about the housing crash. But that wasn't the first crash. If you look back here in 1990, there's another little blip. And it looks small on this chart. But if you actually got rid of everything to the right and just looked at that, that actually was a pretty big drop. It went from median price house of 126, it went down to 117. But if you notice, it was back up to 126 2 years later. This is 1992. This is 1990. So even though that real estate crash in 1990, it crashed down pretty decent amount, it was right back up in a couple years. Well, what happened in 2007? The median price at that point was at 257. If you notice, it's almost double. And how long was that? That was 15 years, 16 years. The price doubled, and that's actually a pretty good example. If you look at this chart, the angle is about the same. From 1975 to 2007, the angle's the same. So most people would look at a double in about 10 to 12 years on real estate. Okay? So anyways, you have a median price now of 257. And then, of course, we all know we had the housing crash, and it went down. The median price went down to 208. Pretty big drop. But if you fast forward a few years, 2012, you're right back up to 251, almost 251.7, almost where you're at. So from the top of the peak in 2007, if you had just kept your house for 5 years, you would have been back even to where you were. You wouldn't have gained, you wouldn't have lost. But if you kept it after that, you can see that it goes right back up and you gain again. But 5 years later, you're even. In fact, if you went through the crash anyways, because most people didn't sell in 2007. They were in the house, their housing price dropped, and maybe a year or so later in 2008, they sold it. Maybe they sold it for $226. They lost $30,000. If they had only kept that house for a few more years, they would have been back right up where they were at before, at their high point, 2012. How does that relate to the current market? Well, there's also a fear that we're currently in a bubble and that the price is going to crash again. Now, there's arguments as to why it's not likely that's going to happen. The reason for this crash in 2007 and 8 was because these home values, if you notice the volatility up and down here, this is mostly smooth back into the 80s and 90s. But once you got into the after 2000, it was a lot of ups and downs. And that's because, as we all now know, if you've watched the movie Big Short or any of the other movies like that, or read about the housing crisis, there was artificial government incentives built into the market. And those incentives were mortgage guarantees. If you were a borrower and wanted to buy a house, you could pretty much buy a house no matter who you were. You had no income, no job, no assets, no credit. They called them ninja loans. No income, no job, no assets. Ninja. And you could even have bad credit. So the government was artificially propping up the market by guaranteeing mortgages. So if you were a bank, you could lend on a house, and it didn't matter if the person didn't pay. The government was going to bail you out if you had a borrower that didn't pay you money. So that's why the housing market went up during that period. That's what made it get to that point. In fact, it hadn't even really ballooned too much beyond the normal pathway. If you draw a straight line from 1985 to 2005, the trajectory is about the same. It didn't spike up. What happened is it actually dropped down. There was not a balloon. There was just a drop because those mortgage guarantees were excessive. There were too many people that had purchased homes who could not afford them. Their mortgage payments were too high. Their mortgage broker put them in a loan that maybe was $3,000 or $4,000 a month, and maybe they made $50,000 a year. You can't pay that. Or maybe you had an interest-only loan that had a low payment for the first year or two, but then it jumped up and they couldn't afford the payment. The current market for homes and the current increase in price has nothing to do with artificial government incentives making loans guaranteed. Now, there's an artificial interest rate reduction where the interest rate's pretty low, 2, 3, 4%. But that doesn't affect the mortgage payment too much, and it doesn't retroactively affect people who are already in a home. These are mortgages where they were given to somebody who couldn't afford it from the first day they bought the house. Or it was a variable rate that if the mortgages went up, the payment was going to go up. The current buyers of homes are largely cash buyers or people with healthy down payments, good credit, good income, and verified income. So the current ownership of homes is not at risk from being reduced because people have to sell. Remember short sale? If you had a house and you couldn't afford the mortgage, you did a short sale. There's no short sale in this market, right? These people don't have to do a short sale. They don't have to sell it below their mortgage. And they can afford the payment because they were heavily scrutinized when they purchased the home. They didn't have to just fog a mirror. They go through heavy, extensive financial evaluation by the lender before they get a mortgage. So these more recent home buyers are not at risk of having to panic sell or distress sale their home. Now, are the prices going to continue to go up at the same rate, 15, 20% a year? Well, that remains to be seen. It may not be able to sustain 20% forever, because if that was the case, it would double every 5 years instead of every 12 years. But even if it goes up 10% a year, that's a double in 7, roughly. And it's very unlikely, it's very hard to see how there could be a legitimate financial circumstance where the prices will go down from where they are now. May not go up as fast, but it's hard to see where they would go down. Who's going to sell the house for less than what they paid for it? Right? Because you don't have to. There's no reason to. People will not be forced to sell homes. These new buyers, these new homeowners that purchased in the last 3 years, especially, they're all heavily credit checked. That's number one. Number two, they purchased in a distressed economic environment. There was already a job problem. There was a pandemic. There were lockdowns. So anybody who bought a house in this market was pretty solid financially. They weren't somebody who lost their job in the pandemic. They weren't somebody who had their income reduced in the pandemic. These people that bought in the last 3 years were solid. They had a job that made it through the recession, who made it through the lockdowns, who made it through the pandemic. That's who bought houses in the last 3 years. If they made it through that, it's very unlikely that any large majority of them are going to be forced to sell their house and lose their house in the next 3, 4, 5 years. It's not going to happen. So even if there was some type of a downturn in the market, history tells us in 2 or 3 years it's going to be right back where it was, or 4 years maybe. And that's if there's a crash in the market. And there's nothing to say that there are factors that could make it crash. Sure, there's what they call a black swan event, something that shows up that nobody expects, nobody could see, and that could crash the market. Something that nobody's aware of. But the fundamentals for real estate, meaning the inventory, the number of houses for sale versus buyers versus demographics, millennials coming into the marketplace, Gen Z getting old enough where they want to buy a house, starting families. Those fundamentals are there. And the negative inverse fundamentals of people who own homes that are forced to sell or have to sell cheap, those don't exist because there are no buyers recently who were borderline buyers. Everybody who's a buyer recently was a solid buyer. And if you go back earlier, if you say, well, maybe people that bought 10 years ago are borderline. Maybe they were, but they bought so much cheaper that they have equity in their house. So they can afford to withstand negative consequences. Take out a home equity loan where their payment's low to begin with. What do the experts say about it? Well, you don't want to take any one person's opinion, but Zillow says housing inventory won't return to pre-pandemic levels until 2004. Now, of course, Zillow might be biased. They have a dog in the hunt because they're in the real estate advertising business. But their projection is that the inventory is going to be tight for another 2 years, at least. And by then, the inflation and the bottom line is that there's very little evidence that something could happen that will crash real estate values. They may not continue to go up at the same rate, but having them go down any significant amount for a long period of time is highly unlikely, even with interest rates going up. I get it. Interest rates are going up from 2.5 to 4.5, maybe 5. They may be 6 within the next 2 years. But that will affect the payment of a median house, maybe $500 a month, $600 a month. That's nothing to sneeze at. That's a significant amount. But a buyer who really wants a house will find a way to fit another $500 in their budget. They're not going to let that deter them from the new reality of what makes people want to buy a house. The $500 is not going to be the obstacle. The obstacle would be the fear of missing out on a house, or if the house prices were dropping, they wouldn't buy. But there is no fear in the market at this point from buyers. Buyers are really still in the FOMO stage of missing out on homes. They're still inventory is at an all-time low, less than 1 month inventory in most places, or it used to be 3 or 4 years worth of inventory. So look at hard numbers, make your own decisions. We're not giving you financial advice or legal advice, but look at the numbers and look what is behind the history of the numbers so that you can make a smart decision and not just believe what somebody says, whether it's Zillow saying housing market's going to be good for 2 years or some other financial advisor saying it's going to crash. You don't want to guess and pick who you think is right, because that's like betting on a horse. You don't know how good that horse is or what they're going to do that day. You don't want to believe any one person. Look at facts and data like history. Even when there was a housing crash that was for criteria and reasons behind the scenes that are not in place today, in 4.5 years, it was back to what the values were before the crash. So it's unlikely that's going to happen. So making a decision about purchasing a house has a lot to do with prediction of the future. It should be about if you want to be a homeowner regardless, but if you do want to look at the data and the probability, this is a good place to start.